Chapter 11. The Nation. Inside the System, Outside the Circle. Part 1. Introduction. National systems built on foreign currency. Most countries today have built domestic financial systems modelled after the United States. They issue their own fiat currencies, create stock markets, build central banks, and tie their national wealth to real estate, equities, or government bonds. On the surface, these systems seem stable. They support everyday life in cities like Buenos Aires, Lagos, and Jakarta. But globally, all of these systems still rely on one external anchor, the US dollar. The dollar accounts for nearly 60% of global foreign reserves and close to 90% of all currency exchanges. It's the standard for global trade and the currency used to buy critical imports, like oil, medicine, and machines. And while the US can create it freely, other countries cannot. They can't print it, they can't control its flow, and they don't receive it when America prints trillions in new money. This dependence becomes especially painful during financial crises. When the US Federal Reserve raises interest rates, global dollar supplies tighten, and countries around the world face hard choices in a system they don't control. Part 2. A familiar structure, but no access to the engine. The US financial system is a self-contained loop. When the Fed prints new dollars, they're absorbed by a dense network of assets: government bonds, tech stocks, real estate, and major corporations like Apple and JP Morgan. These assets help anchor the dollar's value. For example, in 2020, the US issued $2 trillion through stimulus programs. Citizens got direct payments, the stock market surged, and consumer spending remained stable. Other countries try to mirror this setup. They have their own currencies, their own banks and stock exchanges, even their own flagship companies. But there's one major difference. They can't generate or access dollars at will. When the US injects new liquidity, that money stays mostly within American borders or gets sent to select allies through mechanisms like swap lines. For everyone else, the engine remains off limits. Part 3. Argentina. A US-style system without the dollar. Take Argentina. It has a national currency, the peso, a stock exchange, state-owned banks, and powerful agricultural firms. In the 1990s, it even tried pegging the peso to the dollar, hoping to import stability. But in 2018, when the Fed raised interest rates, the dollar gained value. Argentina's foreign reserves dropped sharply. Its dollar-denominated debt ballooned. Without access to new dollars, the country hiked its own interest rate to 60%, the highest in the world. Still, the peso collapsed, inflation soared, and imports became unaffordable. The US handed out stimulus. Argentina could only print pesos, which had no value outside its borders. Part 4. Nigeria. Dependent on dollar-denominated oil. Nigeria's system also looks familiar. It has the naira, a national stock market, major banks, and an oil giant, NNPC. Oil makes up 90% of its exports and provides the dollars it needs to import food, medicine, and industrial goods. But when oil prices fell in 2014, Nigeria's dollar income vanished. The country tried to defend its currency by raising interest rates, but without Fed support, reserves dried up. Inflation hit 18% and investment fled. During COVID, the US printed trillions. Nigeria couldn't. Its people faced shortages, closed businesses, and steep price hikes. The dollar system was out of reach. Part 5. Japan, a special case inside the dollar circle. Japan is different. It also mimics the US, with the yen, a huge stock market, major banks, and companies like Toyota and Sony. But Japan holds over $1 trillion in US reserves. That gives it power. During COVID, Japan kept interest rates negative, issued direct cash payments to citizens, and managed a mild economic decline, even as the US tightened global dollar supply. Why? Because Japan is part of the dollar's inner circle. It has access to swap lines, a safety net that most nations don't have. Part 6. Brazil. A similar setup without the shield. Like Petrobras, it even holds hundreds of billions in reserves. Still, when the Fed tightened in 2018, the real dropped 20%. During COVID, Brazil's emergency support per person was just $120. Supply chains broke, imports stalled, and the economy shrank. Without access to the dollar engine, Brazil couldn't shield itself. Part 7, a two-tier system. Who gets the dollar lifeline? There's a clear divide in the global system. Tier 1, swap line nations. Countries like Japan, the UK, Singapore, and the Eurozone have official agreements with the US. They can access dollars during crises at fixed exchange rates. Tier 2, everyone else. Countries like Argentina, Turkey, Nigeria, and Brazil don't have this privilege. When dollars dry up, they're left to struggle in open markets, paying high costs and facing no guarantees. Swap lines aren't just financial tools. They're political alliances. They decide who gets to weather the storm and who must survive on their own. Part 8. When the Fed tightens, Tier 2 nations suffer. Between 2022 and 2023, the Fed raised interest rates from near zero to 5.5%. Dollars became scarce. Capital rushed back to the US stock markets abroad crashed. Local currencies lost value. Countries without swap lines had to raise their interest rates sharply just to protect their reserves. That meant slower growth, more inequality, and rising political tension. Meanwhile, swap line countries adjusted gently and kept trade flowing. Part 9. Dollarization, surrender without sovereignty. Some nations try to escape this trap by fully adopting the dollar. Ecuador did this in 2000. Inflation dropped, but the country now relies on exports and IMF loans. It can't issue new dollars. During COVID, it had to borrow billions and couldn't launch its own stimulus plan. El Salvador adopted the dollar in 2001 and added Bitcoin in 2021, but 96% of its economy still runs on USD. It survives on remittances and foreign credit. Panama has used the dollar since 1904. It enjoys some stability, but like the others, it had no tools to respond during a crisis. Its GDP shrank nearly 18% in 2020. Dollarization removes local control, but doesn't grant US support. Part 10. Conclusion. The illusion of sovereignty. Around the world, countries have built systems that look like the United States, but only a select few get access to real power through swap lines and trusted alliances. Everyone else must navigate the same storm without a lifeboat. When the Fed tightens, some countries get balance. The rest get austerity, inflation, and collapse. In this global system, the dollar doesn't just anchor trade, it decides who survives.